Tell me if this sounds familiar. You know what you should do with money. You know you should spend less than you earn. You know you should save consistently. You know you should not panic when markets drop. You know short-term thinking is dangerous. You know all of this. And yet, the credit card balance does not go down. The savings account stays empty a little longer than planned. The investment gets sold the moment it starts falling. The bonus gets spent before it arrives. Knowing the right thing and doing the right thing are two completely different problems, and almost every personal finance book ever written treats them as the same problem. Morgan Housel does not. Welcome to Bookmark, where we explain the most valuable books in the simplest way possible. Whether you are commuting, working out, or just going about your day, just press play, and we make sure the knowledge finds you, not the other way around. Today we are covering The Psychology of Money by Morgan Housel. This is not a book about how to invest. It is not a book about which stocks to buy, which funds to choose, or how to read a balance sheet. There are plenty of books for that. This is a book about something far more important and far less discussed. It is about how human beings actually think about money. The beliefs, the biases, the blind spots, and the behaviors that determine whether people build wealth or destroy it, regardless of how much they earn or how much they know. Morgan Housel's argument, and it is one of the most clarifying arguments written about money in recent decades, is this: financial success is not primarily a hard skill. It is a soft skill, and the soft skill is how you behave. By the time we are done today, the way you think about money will be different, not because you will have learned a new strategy, but because you will understand something about yourself that most people never examine. So, let us get into it. The first thing Morgan Housel wants you to understand reframes the entire conversation before it even begins. When you look at other people's financial decisions and think, that makes no sense, you are almost certainly wrong. Not because their decision was smart, but because you are judging it without knowing the world that shaped it. Housel opens the book with a simple but striking observation. Every person who has ever lived has grown up inside a specific slice of time, a specific economic environment, a specific set of experiences with money. And those experiences, more than any textbook or financial advisor, are what determine how they think about money for the rest of their life. Someone who grew up during the Great Depression, watching families lose everything overnight, is going to have a completely different relationship with cash than someone who grew up in the 1980s during a long bull market. Neither of them chose their formative experiences. Neither of them is irrational for the beliefs those experiences created. They are both responding to the world they actually lived in. Housel puts it plainly. People do seemingly crazy things with money, but they are making decisions that make sense to them given the information they have and the experiences that shape them. This is the foundation of the entire book. Before you can understand your own financial behavior, you need to understand that your financial behavior was largely formed for you, not by you. Your intuitions about risk, about savings, about spending, about what counts as enough, were shaped by a world you did not choose to be born into. And once you understand that, two things happen. You become more forgiving of other people's financial decisions, and more importantly, you become more curious and less defensive about your own. That curiosity is what this book is really asking of you. But before we get into the specific ideas, there is one concept Housel introduces early that sits underneath almost everything else in the book. It is about the role of luck and risk, and it is one of those ideas that sounds obvious until you actually sit with what it implies. Take a name most people recognize: Bill Gates. One of the wealthiest people in human history. Brilliant, driven, visionary, a self-made story in every sense of the word. Except Morgan Housel points out something most people never stop to think about. Bill Gates attended Lakeside School in Seattle. In 1968, Lakeside was one of the only schools in the entire world with a computer terminal available to its students. The odds of a young American attending a school with that kind of access were roughly 1 in a million. Bill Gates happened to be that student. Now, this does not diminish what Gates built. His talent and work ethic are real, and they mattered enormously. But among the millions of teenagers in 1968 with the same intelligence and the same drive, almost none of them had access to a computer. We will never know their names, and that is Housel's point. Success always contains a hidden ingredient called luck. Not entirely luck, but some luck. And the amount is almost always larger than successful people acknowledge, because acknowledging it feels like diminishing the work they genuinely put in. The flip side of luck is risk. For every person who took a chance and succeeded, there are others who took the exact same chance, with the same information and the same effort, and failed. Not because they were worse people, because the outcome had a random element that fell against them. This matters for how you think about your own financial life in two specific ways. The first is about humility. When things go well financially, it is worth asking honestly how much of it was skill and how much was timing, rising markets, or circumstances you did not control. That humility makes you more careful going forward and less likely to take excessive risks on the assumption that past success was entirely earned. The second is about compassion, including for yourself. When things go badly, it is worth asking how much was genuine poor decision-making versus circumstances that simply turned against you. Financial failure often carries enormous shame. Some of that shame is deserved, but a meaningful portion belongs to risk, to the random element that nobody talks about because it makes financial outcomes feel less like a story of pure merit. Housel is not saying luck and risk are excuses. He is saying they are real, and ignoring them leads to arrogance in success and unnecessary shame and failure. Neither serves you well, and this leads directly into one of the most practically important ideas in the book, something Housel calls getting wealthy versus staying wealthy, because these are not the same skill, and confusing them is one of the most common and most costly mistakes people make. Something that should be obvious, but rarely is. The skills that help you build wealth are almost the exact opposite of the skills that help you keep it. Getting wealthy often involves optimism and risk-taking, seeing an opportunity others missed. Concentrating resources, moving fast, tolerating uncertainty. Being willing to be wrong and staying in anyway. Staying wealthy requires something completely different, a kind of fearful humility, accepting that what worked before might not work again. Genuine caution, survival above all else. Morgan Housel points to Jesse Livermore as a striking example. Livermore was one of the greatest traders of the early 20th century. In 1929, he correctly anticipated the stock market crash and bet massively against it. On the single worst day in American stock market history, he made the equivalent of $3 billion in today's money. Within a few years, he had lost it all. He applied the same aggressive, high-conviction approach that had made him rich to a different environment. The skill that built the wealth became the behavior that destroyed it. He never made the shift from getting mode to keeping mode. Housel uses this to make a point that sounds deceptively simple. The most important financial skill is not earning more. It is survival. Staying in the game long enough for compounding to work. Not making a catastrophic mistake that ends the run. The ability to do what you want, when you want, for as long as you want, requires surviving all the surprises and setbacks that any long financial life will inevitably include. And the key ingredient of survival is not intelligence or discipline. It is something harder to manufacture. It is the genuine belief that something can go wrong even when everything is going well. Because things will go wrong. They always do. The question is whether you have positioned yourself to survive the ones you did not see coming. And this brings us to a concept that changes the entire relationship between money and time. It is arguably the most powerful idea in personal finance, and it is almost always underestimated. Warren Buffett's net worth at the time of writing this book was around $84 billion. Most people assume this came from brilliant stock picks across his entire career. But Housel points out something more interesting. The overwhelming majority of Buffett's wealth was accumulated after his 50th birthday. Not because his strategy changed, not because he got smarter, simply because he had been compounding for so long that the mathematics became almost incomprehensible. Buffett started seriously investing at age 10 and has never stopped. That is over 80 years of uninterrupted compounding. There is almost nobody else in the history of investing with that time horizon. And the results look almost impossible precisely because of that time horizon, not because of any single brilliant decision. Housel's point is direct. Buffett's most underrated skill is not picking stocks. It is longevity. It is staying in the game. So what does this mean practically? Good investing is not about earning the highest possible returns. It is about earning pretty good returns for the longest possible period of time. Consistency and longevity beat brilliance and volatility almost every time because compounding is so heavily weighted toward time. And the practical implication follows from this. The biggest financial risk is not a bad investment. It is anything that forces you out of the game permanently. Running out of money, debt you cannot service, a bet so large that losing it means starting over. These are the things that interrupt compounding and destroy the advantage that time gives you. Survival is the strategy. Everything else serves it. But understanding compounding intellectually is easy. Acting in a way that lets it work is genuinely hard. And the reason it is hard has nothing to do with mathematics. It has everything to do with one of the most consistent and most costly patterns in how people think about money. In 2008, just before the financial crisis, house prices in America had been rising steadily for years. Mortgage-backed securities were being bought and sold at prices that, in retrospect, were completely disconnected from reality. Were the people buying them stupid? Were they ignoring the risks? Some of them, yes. But many of them were not. Morgan Housel makes a point that most financial postmortems miss entirely. Many of the people buying those securities were short-term traders. Their time horizon was months, not years. They were not making a long-term bet that house prices would rise forever. They were betting that prices would keep rising for just a little longer, long enough to get in and get out with a profit. And for a long time, they were right. The problem was not that they were playing a foolish game. The problem was that long-term investors, people with completely different time horizons and completely different goals, were watching the short-term traders and using their behavior as a signal. If they are buying, maybe I should too. If this keeps going up, maybe it belongs in my portfolio. Two completely different players with completely different objectives, looking at the same price and drawing completely different conclusions. And one group drawing the wrong conclusion because they were copying the wrong reference point. Housel calls this one of the most underappreciated sources of financial error. You and the person next to you are not playing the same game. Your time horizon is different. Your goals are different. Your risk tolerance is different. And yet financial markets produce a single price that everyone is looking at. That price does not know which game you are playing. This is why following what others are doing with money is so dangerous. What makes sense for someone else's situation may be completely wrong for yours. And yet the psychological pressure to copy others when they appear to be winning is enormous. Housel has a name for the force behind that pressure. And it is one of the most important concepts in the book because it operates quietly in the background of almost every financial mistake people make. Rajat Gupta was the CEO of McKinsey, one of the most prestigious and well-compensated roles in global business. He had, by any reasonable measure, more money than he could spend in several lifetimes. And then he risked all of it, his reputation, his freedom, his legacy, to illegally obtain a little more. He was convicted of insider trading in 2012. Bernie Madoff ran the largest Ponzi scheme in history. He was already wealthy before the fraud began. He did not need the money, but accumulation had become disconnected from any rational concept of enough. Housel uses these stories not to make a moral argument, but a psychological one. The hardest financial skill, he argues, is not saving money or picking investments or managing risk. It is knowing when you have enough. And the reason it is so hard is that modern life is extraordinarily good at making enough feel like it is always just a little further away. There is always a bigger house, a more impressive portfolio number, a lifestyle upgrade that seems reasonable given what others around you have. The goalpost moves. And it moves specifically because other people keep reaching the last goalpost you set, which makes your current position feel ordinary rather than successful. This is what Housel calls social comparison, and it is one of the most reliable engines of financial misery in modern life. The problem with using other people as your financial benchmark is that there is no endpoint. There will always be someone with more. If your definition of enough is relative to others, you will never reach it, because the others keep moving too. Housel offers a reframe that is simple but requires genuine discipline to internalize. Enough is not the same as the most you could possibly have. Enough is knowing the difference between what genuinely makes your life better and what you are pursuing because comparison has made you feel like you are falling behind. The hardest financial skill is stopping the goalpost from moving. And the only way to do that is to define enough on your own terms, not in relation to what others have or what the next level looks like. This concept of enough connects directly to something Housel considers the highest form of wealth. Something that is almost never discussed in financial conversations, but that consistently shows up as one of the strongest predictors of life satisfaction. What do you actually want from money? Not in theory, not the goal you write in a financial plan. What do you actually want day to day in your real life? Morgan Housel's answer, drawn from years of studying wealthy people and what actually made them happy, is straightforward. Control over your time. The ability to wake up in the morning and decide how you will spend that day. To work on what interests you. To stop when you want to stop. To be present when your family needs you. To take a week away without asking permission. Housel argues that this, more than any specific level of wealth, is what people are actually seeking when they say they want to be rich. They want autonomy. They want the feeling of not being trapped by financial necessity into doing things they would not otherwise choose. And the striking thing is this: that form of wealth, time, and control is available at a much lower level of net worth than most people assume. Because it is not really about the absolute number. It is about the gap between what you earn and what you spend. A person earning $50,000 a year and spending $35,000 has more financial autonomy than a person earning $200,000 and spending $210,000. The first person has options. The second person has a lifestyle that owns them. Housel is direct about this. The highest dividend money pays is the ability to decide. And that dividend is available to people at very different income levels, depending entirely on whether they have built the gap between income and expenditure that creates genuine options. This is why he argues that the ability to save consistently, not invest brilliantly, not earn extraordinarily, but simply save consistently, is the single most powerful financial skill available to ordinary people. Because savings create options, and options create freedom. But saving consistently requires resisting something woven into the fabric of modern life. The desire to signal to others that you are doing well. And that desire is more powerful than most people admit. When you see someone driving a beautiful car, what do you think? Most people think, that person is wealthy. But what you are actually observing is not wealth. What you're observing is a spending decision. A car that cost £100,000 is £100,000 that is no longer in an investment account, no longer compounding, no longer building future options. It is sitting on the road depreciating. Wealth is the assets you accumulate. Wealth is what you do not spend. Wealth, by definition, is invisible. Because the moment you convert it into something visible, a car, a watch, a house upgrade, it stops being wealth and becomes consumption. This creates a fundamental problem with using visible signals to estimate other people's financial position. The person driving the expensive car might be wealthy, or they might be servicing a lease they can barely afford. You genuinely cannot tell from the outside. And yet the human instinct is to use visible consumption as a proxy for wealth, and then to use other people's apparent wealth as a benchmark for your own spending. Housel says this is one of the most reliable paths to financial stress. Spending money you have to signal wealth you do not have, to impress people who are probably doing the same thing. So consider what the two paths actually produce. If you spend money on visible things, you get the visible thing and the social signal that comes with it. If you spend less and save the difference, you get financial options and nobody can see them. The second choice builds the kind of wealth that produces control over your time. But it produces no social signal. Nobody admires your investment account the way they might admire your car. And because human beings care deeply about how they appear to others, the invisible form of wealth is genuinely harder to choose. Not because it is financially worse, because it is socially invisible. This is why Housel is so emphatic that wealth accumulation is, at its core, a psychological discipline before it is a financial one. And that discipline is tested most severely not during market crashes, but during the ordinary years when everything seems fine and the temptation to spend what you earn is at its highest. Now, there's one more idea in this book that deserves real attention, because it is the most immediately practical concept for almost anyone listening. It starts with an honest admission that most financial planning is built on a foundation that does not exist. Most people plan their financial future by making a set of assumptions. Salary will grow at roughly this rate. Returns will average roughly this percentage. Expenses will stay roughly this manageable. And then they build a plan that works if those assumptions are correct. The problem is that the assumptions are almost never exactly correct. Not because the planning is bad, because the future is genuinely uncertain in ways no model can fully capture. Economies change. Markets behave in ways nobody predicted. Health changes. Careers change. The world changes. Morgan Housel argues that the most important thing you can build into any financial plan is not accuracy. It is room for error. He calls it a margin of safety. If you are building a bridge designed to hold 10 tons, you do not build it to hold exactly 10 tons. You build it to hold 30 tons, so that when the unexpected happens, when conditions are worse than projected, the bridge does not collapse. Your financial life works the same way. A savings rate that is just enough to meet your retirement target assumes everything goes to plan. A savings rate that builds a significant buffer means that when something unexpected happens, and it will, you are not starting over. You are adjusting. The person who saves aggressively is not doing so because they know exactly what will happen. They are doing so because they know they do not know. And they want enough room between their current position and disaster that when the uncertain future arrives, they have the flexibility to adapt. The future is not a slightly modified version of the present. It is something genuinely different in ways we cannot currently see. The people who survive long financial lives are not the ones who made the most accurate predictions. They are the ones who built their financial lives to withstand a wide range of outcomes, including outcomes they never specifically anticipated. Housel quotes a Napoleon definition of genius that applies perfectly here. A genius is someone who can do the average thing when everyone around them is losing their mind. Financial genius is not making brilliant calls. It is remaining rational and staying in the game when conditions make it tempting to do something dramatic. And the ability to remain rational under pressure is directly connected to whether you have room to absorb the pressure in the first place. A person with no financial buffer has no choice but to react when things go wrong. A person with significant room for error has options, and options are what allow rational behavior when emotion is pushing toward panic. This is why Housel's advice for building a strong financial life is less about optimization and more about resilience. Not the highest possible return. A good enough return with enough flexibility that you can stay the course through the inevitable disruptions of a long financial life. And this connects to the final and perhaps most clarifying idea in the entire book. Because once you understand it, many of the things that feel like financial wisdom start to look like something else entirely. Think about what purely rational financial behavior actually looks like. A purely rational investor, one with no emotional response to market movements, would never sell during a market crash. They would understand that markets recover, that short-term volatility is normal, that the rational move is always to hold or even buy more when prices fall. And yet almost everyone sells during a crash. Not because they are stupid, because they are human. Morgan Housel makes a distinction here that reframes what good financial advice actually looks like. There is a difference between rational and reasonable. Rational means mathematically optimal. The decision the model says will produce the best outcome if your assumptions are correct. Reasonable means making a decision you can actually live with, one that accounts for the fact that you are a human being with emotions, with stress, with a family, with a life happening around your investment portfolio. A decision you will be able to maintain through the difficult periods without abandoning it at the worst possible moment. Reasonable financial decisions will almost always outperform rational ones in practice. Not because the maths are better, but because a good plan you stick to is infinitely better than a perfect plan you abandon. Take a concrete example. A rational investor would put 100% of their portfolio into equities for the highest possible long-term return. A reasonable investor might keep 15% in cash and bonds, not because it maximizes returns, but because during the next market crash, having that 15% means they do not have to sell equities at the bottom to meet expenses. They can hold. And holding, even with the mathematical drag of that 15%, produces better real-world outcomes than the theoretically optimal portfolio that gets sold at the worst possible moment. The point of reasonable financial behavior is not to look good on paper. It is to produce a financial life you can actually navigate through decades of uncertainty without making catastrophic decisions when things get hard. And the way you build a reasonable financial life is simpler than most financial advice suggests. Spend less than you earn. Save the difference. Give your savings time to compound. Do not interrupt the process unnecessarily. Be honest about your actual risk tolerance rather than your theoretical one. Build room for error. Define enough on your own terms. None of this is sophisticated, all of it is hard. Not because the concepts are complex, but because they require consistently choosing long-term thinking over short-term feeling. And that is a psychological challenge, not a mathematical one. Which is exactly what this book has been arguing from the very first page. So here is what the psychology of money is actually saying beneath all the stories and examples. Financial success is not primarily about knowledge. Almost everyone knows what they should do with money. Financial success is about behavior, and behavior is shaped by psychology, by the experiences that formed you, by the social pressures you operate under, by the emotional responses you have to risk and loss and gain. Luck and risk are real. Acknowledging them makes you more careful in success and less ashamed in failure. Getting wealthy and staying wealthy require different skills. Survival is the strategy. Everything else serves it. Compounding is the most powerful force in personal finance. And its power comes almost entirely from time. The most important thing you can do is stay in the game long enough for it to work. You are not playing the same financial game as the people around you. Copying their behavior without understanding their goals and time horizon is noise, not information. Enough is the most important word in personal finance. And you have to define it yourself on your own terms, or the goalpost will move forever. The highest form of wealth is control over your time. And that is available at a lower level of net worth than most people think, if the gap between income and expenditure is wide enough to create genuine options. Wealth is invisible by definition. What you see is spending, not wealth. Building the invisible kind requires resisting the very visible pull of social comparison. Build room for error. The future will not be what you predicted. The question is whether your financial life can absorb the difference. And finally, reasonable beats rational. The best financial plan is not the one that looks perfect on paper. It is the one you can actually maintain through the long, unpredictable, emotionally demanding reality of a human financial life. Morgan Housel did not write this book to tell you what to do with money. He wrote it to help you understand why you do what you do. Because that understanding, more than any strategy or system, is where lasting financial change actually begins. And that is everything from The Psychology of Money today on Bookmark. If this is the kind of learning that works for you, hit subscribe so you never miss the next one. And drop a comment below telling us which book you want us to explain next. We read every single one. See you on the next one.